Good afternoon, everyone. My name is Lisa Huber. I'm the Vice President of Marketing and Business Development for the University of Minnesota Alumni Association, and I'd like to welcome you to our webinar presentation. Our topic today is planning for long-term care. This event is brought to you by the University of Minnesota Alumni Association. We're very happy that you are able to join us. We expect the presentation to take no more than 30 minutes, and there will be some time afterwards to answer as many of your questions as possible during the hour. Keep in mind that your phones and computers are all set to mute, but the Q&A option and chat box are open throughout the entire event for you to submit questions, and we will do our best to answer them at the end of the presentation. Our speaker today is Dominique Latero, a funding specialist from Long-Term Care Resources. Dominique knows this subject very well and has a lot of helpful information to share with you today. If you have any questions for Dominique at any time during the presentation, please use the Q&A option on your Zoom screen. If your question isn't answered today, you are welcome to reach out to her directly after the event. Dominique's contact information will be shared at the end as well. Also, we are recording this online event, so if for some reason you are unable to attend the entire session or would like to review this information later, it will be sent to you and made available on our website. Just keep an eye out in your email inbox in the next day or so. So once again, let me say welcome, and I will turn the microphone over to Dominique. Take it away.
Thank you. Hello, everyone. Thanks for tuning in. Today, we're going to be talking about all aspects of long-term care. Not just insurance, but what it is, when it can happen, and how it can happen. We will touch on the costs associated with long-term care services and where your health care and government programs fit in. We will also take a look at plan designs and the benefit options, as well as the advantages of purchasing through your association. Next. So let's get started with the first item. What is long-term care? Long-term care situations occur when you are unable to care for yourself or perform the activities of daily living for an extended period of time. Now, this can be due to an accident, injury, illness, or cognitive impairments. Care can be received in the home for personal care needs like bathing and dressing. Sometimes homemaker services are needed for meal preparation, as well as skilled care for medical conditions or health issues. Facility care is also used when you have more significant health issues and require round-the-clock care. I would say most people prefer to stay home as long as possible, and most claims do begin in the home as well. Now, many insurance plans will require you to use a licensed professional in the home rather than a personal hire or family. But there are some carriers that will allow you to utilize whatever care provider you want and not go through a professional service provider. Next. When should you begin planning? Well, sooner rather than later. There is no financial advantage to waiting since the rates are based on age, health, and other items that you see here. The younger you are when you purchase a plan, the less it will cost. However, I think the most overlooked reason to purchase sooner rather than later is health eligibility. You must qualify for a long-term care policy, not just purchase one. And every carrier has a comprehensive underwriting process that includes a personal health interview with a nurse, pharmaceutical history verification, and review of your medical records. So the bottom line, the healthier you are when you apply for coverage, the more likely you are to get approved and possibly receive better rates. Next. When can it happen? Well, it can happen at any time. A need for long-term care services can result from any of these issues you see listed here. Accidents and injuries can happen in your 40s. Illnesses and other chronic conditions can get diagnosed in your 50s. However, most long-term care situations usually do occur at the end of our lives beyond age 80. Next. So these next couple of slides will define a chronically ill individual and the activities of daily living. These are the determining factors in deciding whether your situation falls under long-term care or healthcare benefits. Your physician will certify if you are chronically ill when you are unable to perform the activities of daily living without assistance or supervision for a period of time lasting longer than 90 days. If you are ADL deficient due to an accident, injury, or illness, but you expect to recover within 90 days, then your health insurance will cover the costs. Prime example here would be a hip replacement. When you fall and break your hip, you will certainly have ADL deficiencies, but you will typically begin rehab right away and recover within 90 days. So this would technically fall under your health care. Next. So here are the actual activities of daily living, which measure an individual's ability to live independently. They include bathing, continence, dressing, eating, transferring in and out of bed or chair, and toileting. Next. Instrumental activities of daily living are a little different. Now, these certainly relate to independent living, but they are not considered when determining a chronic illness or long-term care eligibility. Now, I will say that these services are often included in home care situations, but they'll still require those ADL deficiencies to trigger your long-term care benefits. Next. So how to receive your benefits. This kind of piggybacks off those last few slides. To be claims eligible, your physician must certify that you are unable to perform at least 2 out of those 6 activities of daily living for at least 90 days, or have a cognitive impairment such as Alzheimer's, dementia, or a traumatic brain injury. Next. I'm sure many of you have heard the statistic before. Nearly 70% of Americans who reach age 65 will use some form of long-term care services during their lives. And it really helps to know what the costs are for long-term care services in your area. So here are the national average costs for the 4 types of services. We have home care, adult daycare, assisted living facilities, and skilled nursing homes. We can also look at the projected future costs based on growth in past years. And this will help guide you in determining how much coverage to purchase or how far your own savings and investments will take you. Next. So these next few slides will show the costs and future potential costs for a few different states. So here are the annual median costs for the state of Washington, as well as the state of California from year 2020, and then future projected costs for year 2045. As you can see, they're not too far off from one another. Next. So here are the costs of care, again, year 2020 versus year 2045 for the state of Colorado and the state of Illinois. Now, these 2 states are very similar in home care expenses and assisted living facilities, but are different when it comes to skilled nursing homes. Looks like Colorado is slightly more expensive. Next. And finally, here we have the cost of care, again, year 2020 versus future year 2045 in the state of New York versus the state of Florida. Now, here's where you're going to see a significant difference in costs, specifically in skilled nursing homes. So it really does depend on what state you live in to determine how much risk exposure there is for the cost of care. Next. When you are thinking about how you are going to cover the costs for these long-term care services, there are really only 3 ways. You have government assistance, self-insuring, and transferring the risk. Medicare is essentially health insurance and will only cover up to 30, 60, or 90 days post an accident, injury, or illness and that's dependent upon the coverage option that you selected when you signed up. Medicaid requires you to spend down all your own assets and has income requirements to meet in order to qualify for those benefits. VA benefits also have eligibility requirements such as income level, disability, and service level. Self-insuring is just paying out of pocket, using all your own savings and investments to cover the costs. Transferring the risk by purchasing a long-term care policy is going to be the most cost-effective way of protecting yourself. And this is primarily due to the day one leverage. Next. So how to choose your benefits. There are 4 core policy features that you must select in order to build a long-term care plan. First is the daily or monthly benefit. This is how much money your policy will pay towards your care. And the carriers will typically have minimum and maximum benefit levels for you to choose from. Next, we have the benefit duration. This is how many years the policy will pay once you start needing care. Most carriers offer 2 years up to 6 years of coverage, but for those who are uncomfortable with the idea of running out of benefits, we do have some options that offer lifetime coverage. The benefit duration will also determine the policy's value, or what we call pool of money, and I will show you how this is calculated a little bit later. The elimination period is essentially the deductible. Most insurance plans require an out-of-pocket expense prior to receiving benefits. This is the same, but in time, rather than a specific dollar amount. And again, the carriers will have several options to choose from, but standard is 90 days. Last, we have inflation protection. I like to keep it simple and think of it as interest growth on your long-term care money. You want to purchase a plan when you are younger and in good health, but you most likely will not need to use the coverage for many years, and costs will probably be much higher. So adding inflation protection will help your benefits keep up with the rising costs of care. Next. So here is how the benefits you select create your pool of money. And this is a simple math calculation. You take your daily benefit amount and multiply that by your benefit duration, and that creates your account value, or pool of money. For example, if you select $100 a day in coverage for 2 years, that equals $73,000 in coverage. Now think of this as your long-term care bank account. I have $73,000 in my account and a maximum withdrawal per day of $100. If I take my $100 maximum withdrawal every single day, I'm going to run out of money in 2 years. However, if I only take $50 a day to pay for my care, then it will take me 4 years to drain down my account value. It's really all about the money, not the duration. And you have control over how quickly you exhaust your coverage or opportunity to preserve it. Next. With traditional long-term care plans, there is flexibility in designing your own coverage. They allow you to choose different elimination periods. You could choose anywhere from 0 up to 365 days out of pocket before the policy benefits kick in. You have several inflation protection options to choose from as well. Some carriers offer guaranteed purchase option, which means you technically buy it each year, or you can opt out not to increase the benefits. All carriers do have a 3% and a 5% compound interest rider on their plans. And some carriers will offer alternative options like 1% or 2%. Other optional benefits, or what we call riders, are also available for an additional cost. I would say shared care is very common among couples so that they can borrow or inherit each other's benefits if needed. And all of the rider features will vary by carrier, and they will certainly also add to the base premium. Next. The top two inquiries that we receive when we first start speaking with someone is how much does it cost and what does it cover? While there are many factors that determine the cost and eligibility for coverage, we do have a rate calculator that allows members to quickly create 3 basic plan designs for traditional coverage. The link on the page here will take you to the tool on our website. You just need to input your age, gender, and state. Now, this is not a quote for insurance, but simply a tool to provide you with an idea of the costs. Next. So there are 2 types of policies. We have traditional and we have hybrids. Traditional plans are standalone long-term care coverage. You will pay ongoing premiums until you file a claim for benefits. If a death occurs and no long-term care services were needed, there is no residual value to them. These typically have lower annual premiums, they have discounts for joint policies, and they offer additional benefit options like return of premium or shared riders. Since the premiums are lifetime ongoing, they are subject to future rate increases. They're not fixed to never change. Now, the hybrids are a combination of life insurance or annuities with the long-term care benefits. So these have guaranteed benefits for whichever occurs first, death or long-term care. Hybrids have flexible premium options that are guaranteed to never increase. You could typically pay the premiums over 5 years, 10 years. You can even buy it outright in a lump sum of money if you want. You can also reposition assets by rolling over cash value in existing policies or investment accounts via 1035 exchange. Next. So these next few slides are about the group benefit we developed to help members and their families navigate through long-term care situations, which can be emotionally and financially draining. The core benefit of the LTCR Plus program is helping members develop a plan for how they will pay for the potential expenses associated with their extended care. Whether it's planning for the financial protection or finding and evaluating quality care, this family benefit is invaluable either way. LTC funding is what we've primarily reviewed today. We are able to shop the market with top insurance carriers to determine which product is a good fit for you, or we can take a look at existing assets and help determine which should be earmarked for long-term care expenses if traditional insurance protection is not an option. Next. LTC Navigation benefit is one of the most valuable services. It is designed to help members deal with the complexities of finding the long-term care services that either they or their family members may need. Whether it's a care assessment, creating or evaluating a plan of care, or just simply finding quality care providers, our concierge team will also assist in understanding your benefits and help get the claims process started as well. Next. The Care Audit benefit is designed for those with family members who are already receiving care. And since families are typically spread out geographically, it can also be difficult checking in on them. So this service provides detailed assessments and regular auditing on the quality of care that they are receiving, which can reduce stress and provide peace of mind that your loved ones are properly cared for. Now, depending upon the level of assessment, there could be a charge for this specific service here. Next. When long-term care situations arise, the need for certain legal documents will be necessary. The legal benefit can help you and your family save time and money by developing these documents through the online resource that's sponsored by LawAssure. You can create wills, medical directives, power of attorneys, etc. You can print out copies to share with family, but all of your documents will be saved in your profile if you need to edit them in the future. Next. that concludes this for me. I want to thank you all for attending, and I hope you found this informative. If you have any questions pertaining to your long-term care planning, please feel free to reach out to me, and I'd be happy to discuss a personalized plan for you. Just a quick note on the traditional long-term care rate calculator that I mentioned earlier. If you'd like to get a general idea of costs for traditional coverage, the link is here on the screen for you to go ahead and take a peek and get some basic quote costs for yourself. So now we're going to open it up for the questions. John, you want to get us started with that?
Sure, thanks, Dominique. The first question here is, if a widow never makes a claim against her LTC plan before passing away, is there an asset there that can be passed on to an heir? It sounded like you said a spouse could inherit. Is that only the one? Is that the only person, not adult children, for example?
Correct. So it would depend on the type of product that you purchased. Some plans, some standalone plans for an individual person do not have residual value. If you bought it with a spouse and linked it with the shared care, then the spouse would inherit the benefit. The only way, I guess, an adult child would inherit anything is if you buy a hybrid that's linked to either a life insurance or annuity, and you passed away and you selected them to be the beneficiary. They would not inherit the long-term care. They would inherit either the death benefit payout or the value of the annuity, not the long-term care.
Great, thanks. The next question, how much will Medicare pay for long-term care? And what is the difference between Medicare and Medicaid?
So Medicare is health insurance. So they cover doctors, hospitals, prescriptions, and medical treatments. They typically do not cover long-term care services unless it is within the first 30, 60, or 90 days from the acute incident. So for example, if you have a stroke and you end up in the hospital, that's all covered under your Medicare, your health insurance. If you're not quite ready to go home, you need to go to a nursing home, or maybe you are able to go home, but you need some assistance, they will cover up to 30, 60, or 90 days of that post-hospital discharge to pay for the care provider. Outside of that, they do not cover long-term care services. They're not going to come in and help take care of the home. They're only going to come in and help take care of the medical care that you might need, wound care, therapy, speech therapy, things like that. So that's the first part. The second part to that question, the difference between Medicare and Medicaid is they're both health insurances technically. Medicare is what you pay into. You're still going to have, a premium to pay and things like that. That's the Medicare. That's the health insurance that you've been paying into that you get to collect once you turn 65. Medicaid is also a health care plan, but it's provided by the state. So it is the state-funded benefit when you have essentially our low income. And that's your income requirements are based on the state, so everyone's different. It's typically anywhere between $1,700 and $2,000 a month that will qualify you for Medicaid. Next question.
Yep. There's a question here. Are there costs for using the presenter services?
No.
Nope.
To get
the only cost of the program is the insurance itself. Everything else is complimentary, including Dominique's expertise.
Yeah. Yeah. So if you're just calling in, you just want to get some advice, you want to get my opinion on something, guidance, absolutely. So the plus benefits that we last went over, concierge, audit, all of those things are completely free. The only thing that would ever cost you is if you wanted to purchase a long-term care plan.
Next question. Can you give a rough idea of the group benefit for the Alumni Association? How does it compare to the cost of an individual plan?
So the group benefit is, it isn't an actual, this is always very confusing. The group benefit is our expertise, our assistance. And the actual insurance policy is the insurance coverage that's going to help pay for your care. So they're quite different. Not sure if we need to elaborate. I don't know how else to explain that.
One of the primary benefits on top of the program itself is a proprietary discount for alumni that you can't get on the street. So the products themselves can be purchased in and out of this program. However, buying through the association, not only do you have the backing of Mercer as well as the Alumni Association, but you also get an annual premium discount on a traditional LTC policy. Next question. Explain why very low income and assets people and high wealth don't buy.
Oh, well, okay. So typically, if you do not have a lot of assets and your income is below 50,000 a year, I would say, and your portfolio is below 50,000, then chances are the state is going to pay for your care if you can't pay for it yourself. You're going to meet the requirements for Medicaid assistance. So typically, people in that financial position, they don't buy long-term care insurance. It might be too expensive for them. A general rule of thumb is that your premium should not exceed 7% of your income. So it depends on at what time in your life you actually acquire a long-term care policy. If you're young, if you're only 40 and your premium is super inexpensive, then you might fit within that and then let it grow, and then you protect what you would save. But typically, people in that income bracket, they don't acquire a long-term care plan. High net worth typically also do not acquire because they can pay out of pocket and they don't see the need for buying a long-term care plan. I mean, that second part, we do still sell. A lot of people with high net worth, they still buy a long-term care policy. They'll typically buy a hybrid, where they'll buy it outright, just transfer a specific dollar amount to make sure that they have a fixed benefit payout at that time, so they don't use their own money. But I think that's a personal preference on that high net worth side of things.
Great.
I will say that most people that buy a long-term care plan are people that have worked very hard their whole lives to put together, a couple $100,000 in savings, and they do have a fixed retirement income, that they've worked on their plan. And a long-term care situation can throw a big wrench in that plan out very quickly. So I think that's really who should be focusing on a long-term care policy.
The next question here is, how do pre-existing conditions affect eligibility?
It depends on the stability and severity of the condition. There are some conditions that will automatically disqualify you for coverage, and those conditions typically are very progressive in nature, Parkinson's, MS, things like that. However, when it comes to underwriting eligibility, they look at the condition itself and they look at the stability and severity. How long have you had it? How many years has it been mild to moderate and under control with medication treatment? That will typically be fine with underwriting. It's things that are newly diagnosed, they're not quite stable, you're still undergoing the treatment course to get it under control. At that time, you wouldn't be able to apply for coverage. You would have to wait until everything has been somewhat resolved and now at a stable level. It's difficult to say what specific conditions would disqualify you because all the carriers are a little bit different. And there are a lot of conditions that would automatically disqualify you. But if that's something that you want to look into on a personal level, you could certainly feel free to email me and I would look up that condition and let you know.
Okay, there's two very similar, so I'm gonna, excuse me, I'm gonna combine them into one since they both go together, Dom.
Okay.
Is the association discount available for my spouse? And then the second part is, and can I buy a plan that both my wife and I can share the benefits so that either one of us can use it if needed?
Yes to the first component. So the association discount is available for spouses, whether you yourself purchase or not. So for some reason, the member is ineligible for coverage, but you want to obtain a plan for the spouse, by all means, the benefit is extended to the spouse. Yes, to the second component, you can buy a plan that you can both share. We do have a true joint policy where you're both actually insured in the same bucket of benefits. But then we also have individual plans that allow you to borrow or inherit each other's coverage. So they're two different styles, but they do extend to both spouses.
Next question. How about tax deductions or credits?
Okay. So long-term care plans are filed more along the lines of a health product. So the premiums can be tax deducted up to the state's limitations, and so forth. The benefits received are not taxable as income as well. So for example, if you are filing a claim and you're receiving a check for $3,000 a month to help pay for your care, you're not going to pay taxes on that $3,000 a month. That's because the benefits received are taxable, tax-free. But the premium you pay in can be tax deductible as a health expense.
Okay, next question. Have LTC providers finally designed plans with either a constant level of annual premiums or one that only rises in cost with inflation and not with the charges being experienced in the senior care industry? It's a really important question, especially when your retirement income goes up only 2% per year, when the cost of the LTC premiums could sometimes increase to 20% per year.
So the only premiums that can possibly go up would be traditional plans. Hybrids have fixed premiums. So if you definitely want a product that would never ever change in cost, but still will go up in benefit increase, you would focus on a hybrid. They tend to be more expensive though, because they have that guaranteed benefit payout and fixed level premiums. Traditional plans, they still have the ability to request a rate increase with the Department of Insurance. And if that happens, it doesn't happen every year. Historically, I think it's every 10 to 15 years that a carrier would look at their policy and look at their books of business and see whether or not they want to request a rate increase from the Department of Insurance. And if that happens, then you could see a letter stating, you know, your premiums are now going to go up to key in for your current benefit selection. Now, you don't have to pay the rate increase. You can elect to reduce your benefits in order to offset that rate increase. So that's one option. What I'm also maybe misinterpreting in that question is sometimes older plans, they used to have what we call like CPI inflation or future purchase option in inflation. And what that means is every year, if you wanted your benefits to grow, you had to pay for it each year. I don't typically sell a lot of those. There are very few carriers who actually offer that anymore because the cost of an automatic compound increase with a level premium is pretty affordable today. And it's really more in line with what your goals are as far as future growth with stable premium. The CPI inflation options, I don't think I know anybody who offers that anymore, where that used to be linked to You know, how the CPI inflation went, that's what they would give you on your benefit growth, and it would sometimes fluctuate your premium. I mean, those don't really exist in what we're selling today.
We've got another question here. Are you giving any option for personal consultation?
Sure, yeah. I mean, if you want to have a discussion with me about your personal situation, your long-term care planning, absolutely. You can feel free to email me, and I'd be happy to set up a time to spend with you, and go over what your options are, what your goals are, what your thought process is on your long-term care planning.
Just circling back to, I know rate increases are kind of a hot button when it comes to people, you know, talking about and researching long-term care insurance. Initially, products were developed under certain assumptions with respect to utilization, claim longevity, et cetera. Also, we were in a different interest rate environments back when certain products were out, which did cause several carriers to need to go request rate increases more frequently than I think the industry and the consumers were comfortable with. It's been our experience, though, as those products have been pulled from the marketplace and then replaced with more appropriately priced products for, again, utilization, lapse rate, as well as the current interest rate environment. I think, and Dominique can attest to this and jump in here, but I feel like rate increases are becoming less and less frequent because of that. And I don't know, Dominique, if you're seeing anything differently within your client base, but that's our, that's kind of what we've been seeing from the home office side of things.
Yeah, they are less frequent, and really a lot of that has to do with they have more knowledge now on claims. They've really narrowed it down. I mean, they have almost 40 years of data to kind of look over. What they do is they focus now on, they know that these policies aren't lapsing. I think that was the biggest misjudgment out of anything, was the lapse rate. And they know that maybe less than 1% of LTC policies actually lapse for non-payment. So with the data that we know today, the cost of care that we know today, the carriers have restructured and repriced. You can't buy these lavish 5% compound interest riders, unlimited lifetime benefits, simplified underwriting for $50 a month. You just can't do it. And that's quite frankly how they were sold in the past, which was silly. It was based on life insurance, not based on long-term care. Now they limit what you can buy, they've reduced the options, and they've increased the pricing to purchase significantly. And the health underwriting is so strict. I would say 50% of people that I talk to, they can't even qualify if they wanted to. It's whether or not they have something that's going to disqualify them for life, or they're currently undergoing treatment that they have to postpone them purchasing until that treatment is done. Physical therapy, for example. A lot of people don't realize that when you're receiving physical therapy, even if it's for tennis elbow or plantar fasciitis, which is very benign, you cannot apply for coverage when you are currently under medical treatment. So they've really, really honed in on health eligibility, which narrows down and reduces their claims risk when they do that. So therefore, I don't think rate increases will occur as much as they did in the past, because they've just done a better job on the front end.
Great. Next question here we have. What if I use some of my benefits and then get better? Is my unused benefit still available later?
Yes, because remember, it's about your pool of money. It's about your account value. So if you have a policy that has $150,000 in it, you use it for 9 months, and you only use $50,000, you could stop that claim. You'll resume your premiums. And at a later date, if you have a second claim, you have about $100,000 left in your policy to use.
Okay. Another question here. It's a good one, actually, with going back to the rate charts across the different states. If I move from one state to another, will I be able to use my insurance in the new state?
Yes, they're portable. So wherever you end up in the US, you'll have access to your full benefits. If something happens outside the US, most carriers have a reduced benefit internationally. And in order to access the rest of your coverage, they'll want you to come home. So if you're traveling and something happens, it will pay some of the care for a while until you get home to use the rest of it.
Here, another question. What if I buy a policy and then many years later, I can't afford to keep it?
So you have really two options. You can reduce the benefits to reduce the premium, or if you forfeit the policy, depending upon whatever product line it is. So if it's a traditional plan and you don't want to keep it anymore and you forfeit it, there's no residual value. You don't get anything back out of it. If it is a hybrid plan, then and you want to forfeit it, you don't want to pay for it anymore. There is cash surrender value in a hybrid plan that you can certainly cash out. It's not usually all of your money back, but it's sometimes at least some of it.
All right, here we go. There's another one. Are the federal long-term care program options similar to those you've described today?
Yeah, so the federal long-term care plan is, I believe it's still sponsored through John Hancock, if I'm not mistaken. It's the same as a traditional long-term care plan. So you pick your three benefits: how much money per day, how many years, and do you want the benefit to increase? And then it'll generate your premium.
I've got a couple here that are fairly similar as well. And these are revolving around with respect to premiums and how expensive they are. It looks like there might be some misconception as to, in fact, how expensive this coverage tends to be. Dominique, I don't know if you would like to give maybe just a couple of examples on kind of some sample policies that you would put together for, let's say, like a 55-year-old couple, maybe a 65-year-old couple, because it looks like there's some confusion as to how expensive these policies are.
Well,
ballpark.
I mean, that's all. Yeah, that's all kind of relative. You know, when you're looking at, you have to understand the value of the benefit. You know, and expensive for one might not be expensive for another when you're looking at the coverage that you're getting and your own personal experience. I found that long-term care plans and planning is a very personal decision. You know, some people who have lived through a long-term care situation with a family member or a friend, and they understand the reality and the expenses of it and how emotionally draining it is, then the value and the price tend to actually change when you're just looking at this as something that, I might not use it, but I guess I'll get something just in case. Then perspective comes into play. But I would say one of the most common benefits selected is $3,000 a month for 3 years with 3% compound interest growth. That's a very, very common selected benefit design. It provides you with about $108,000 in long-term care benefits with a 3% compound interest rider. That means your money will double in 24 years, right? So I would say typically that benefit for a couple on a traditional model would be about, for a mid-50s man, woman couple, would be about $3,000 to $3,500 a year in combined premium for the two people. So that just kind of gives you a ballpark. That rate calculator that you see on the screen, that's going to show you some typical design options for, $100 a day, 3 years, $4,500 a day for 4 years, kind of like your A, B, and C. So it all depends on what you want to do. Not everyone's plan is the same. Some people just want to buy something small to cover a specific dollar amount out of their portfolio that they don't want to spend. Some people want to pay a higher premium to have a higher coverage payout down the line. So I would say anywhere between, depending upon a small plan, you'd be paying for the average couple, anywhere from $2,500 a year up to $5,000 a year for a larger plan on a traditional policy. That has no residual value to it. It doesn't have a death benefit, doesn't have cash surrender, and it does not have fixed premiums to never change. Hybrids are going to be a little bit more expensive, and that's usually because hybrids require you to pay them off in a specific period of time. So you don't continuously pay hybrids. You'll pay them off usually in 10, 15, 20 years time. So you're certainly going to pay more because you're paying it off sooner. But you could pay anywhere between $6,000 a year for 10, 15 years on a hybrid if you're in your early to mid 50s. But if you're 60 and above, you're going to be paying a good $10,000 a year for 10 years to buy a hybrid for a decent size policy, typically about $250,000 with an interest rider, so that grows. So again, they're more expensive, but they do have a lot of residual value. That plan is going to pay out one way or another, whether you go on long-term care claim, decide to surrender it, or pass away. So those about ballpark figures that I could think of.
And that's great. Thanks, Dominique. I think it's important takeaway from that to just check out the rate estimators to get a ballpark idea. Dominique, I know, covered it as well. Plans are highly customizable and are done on an individual basis based on needs and desires, as she had mentioned. So just give her a call, have a brief conversation, and she can better, answer those specific cost questions after a brief discussion. But moving on from that, there was quite a few folks that had similar questions revolving around that. So thank you, Dominique, for covering it in such detail. Next question. What are the disqualifying health conditions that most often occur?
In the application process, a health condition that would disqualify you for coverage, there's a lot, to be honest. Any condition that, again, has a more progressive nature, severe rheumatoid arthritis is one thing that will often see a decline. Rheumatoid arthritis in general is not an automatic decline, but it's going to be dependent upon the medication treatment that you take, whether or not you have joint deformity and mobility restrictions. So when I talk about the severity and stability of a condition, it's not always just the condition, it's how well is it managed. I would say for diabetics, typically will qualify for coverage if it's mild to moderate, under control with medication. If you take a lot of insulin, you have any tingling in the feet, diabetic comorbidities like obesity, tobacco use, neuropathy, tingling in the feet, you're not going to qualify for a long-term care plan, unfortunately. Autoimmune disorders, in general, it's going to be dependent upon stability and severity. But, the list goes on. I mean, there are thousands and thousands of health issues that one might be diagnosed with, but it doesn't necessarily mean it's at a significant level that would disqualify you automatically. One thing to think about in long-term care is that they focus on morbidity tables, not mortality tables. It's a big misconception. So long-term care claims are paid when you are unable to perform the activities of daily living. Mobility is a big claims risk. So musculoskeletal conditions that could cause mobility issues in the future are going to be high risk in long-term care eligibility. Again, it's dependent upon stability and severity. Cancers, history of cancer, as long as it's stage 1, 2, 3, and you've gone through treatment and you are cancer-free for 2 to 3 years, that's not going to be a disqualifier in long-term care because that's a mortality risk, not a morbidity risk. So again, it all just depends on the specific. And if you have any specific inquiries personally, please feel free to email me and I will let you know specifically where your situation falls, whether it's eligible or not.
Thank you. Next question. If I buy a policy, how old do I have to be to get my benefits from it?
Immediately. There's no real waiting period. So if you pay your first premium, 6 months later you have a claim, your full benefit is available to you.
Another question here. How long does it take to get access to the benefits of the LTCR Plus program? And also, can I enroll a family member into the program as well?
We can sign you up today. It's no cost. We can just pop you in, create your account so you have access to it. And yes, it is available to your family members.
Let's see, we got, looks like one more here. What is performed in the audit portion of the LTCR Plus program, and how quickly can that be performed if needed?
So the audit portion, there are several different levels in that, but I would say they would find out what facility a loved one was in and take a look at the care that they're being provided. The assessments would be on the level of care, the dressing, the bathing, the treatment, the so forth. And depending upon that level of reporting, like I said, if it's just a general report on their overall well-being and the chart review, then that's a pretty simple process there. But if you get a little higher level into that detailed assessment, there could be a charge for that. And you can initiate that review immediately with the concierge desk. So when you sign up for the LTCR Plus benefit, you have access to either iChat inside the system with the concierge team. So you could just plug your information in there, send her a message, and she can call you back and you guys can discuss where your loved one is and what you're looking to do.
Great, thanks. That actually completes the questions that I have here in the list.
Okay, great, wonderful. Well, if we didn't get to everybody's questions, or if you didn't ask a question, but you still, want to talk a little further about your own personal situation, again, please feel free to call me, email me, and I'd be happy to walk you through everything and answer your questions. All right. Is that it, everyone? Well, I want to thank you all for joining and spending time with me, and I hope you all have a wonderful day. Thank you so much.